Okay, everybody, thank you and welcome back. So this final session is something a bit sort of slightly off-piece maybe, because we're not talking about investment companies so much. It's more about other structures. And to help us do that, we've got a panel of experts. And this is a bit of a sort of teach-in for all of us, I think. So we're going to ask you to explain what you do. So if you go start at the far end, please, just introduce yourself. And,
sure thing. Hi there. I think we're all good. Can you guys hear me? Yeah. So yeah, Tom Eckert. I'm the editor of ETF Stream. ETF Stream is basically a media house covering the kind of wonderful world of ETFs. We're covering the UCITS market specifically. So that's everything to do with ETFs we're going to be writing about effectively. So looking forward to speaking about active ETFs specifically today.
Hi, I'm Nick Biankowski, co-founder and co-CEO of Harn ETF. We're a white label ETF firm, so create ETFs for third-party asset managers who would like to launch an ETF but don't want to launch an ETF business. And I've been in ETFs for 20 plus years in London.
Yeah, and finally, I'm James Lowe. I work in the Schroders sales team, but I actually focus specifically on private markets, and also you'll be pleased to know investment trusts. So hopefully I can give some critique on both sides, give you some new ideas about what LTAFs are, but also sort of bring that back to how that compares to investment trusts as a structure.
Great, thank you. So to start off with then, can I get Nick maybe just tell us a bit about active ETFs, how they work, what sort of size funds they've got available in the UK already, how many people access them, what for, that sort of stuff.
Yeah, I mean, just a brief description of ETFs. I mean, they're open-ended and exchange traded. The ETF obviously stands for exchange traded fund, so they're a fund they happen to trade on exchange. That means, therefore, they have daily liquidity with intraday pricing. And ETFs are generally as liquid as the underlying asset. Often people say that the ETF doesn't trade on exchange, it's got no liquidity, etc. But it doesn't really matter because ETFs, being open-ended, can be created and redeemed to demand. So if the trading on exchange was $100 for the day or £100 for the day, that does not mean that someone could not trade at £1 million or £10 million easily. As long as the underlying market that is represented by that ETF is liquid, then you'll be able to make that trade. In terms of buying ETFs, being exchange traded, you just buy them through an average brokerage account, your regular brokerage account with all the same order types as equities. So, stop orders, limit orders, etc. Minimum investment is as little as one share. I mean, of course, maybe your brokerage fees could determine how much you want to invest, but an ETF could cost as little as £5 or £10 for a share, and some may cost more depending on whether prices have risen or fallen. And generally, ETFs don't allow borrowing. They do allow leverage via the use of futures or swaps in an ETF, so you can buy a leveraged ETF. But in terms of borrowing, I mean, most ETFs available, probably 98% of them are UCITS ETFs, so they have to therefore follow UCITS rules. There's UCITS diversification rules, and also the UCITS have rules about borrowing, and generally it's 10% limited to short-term borrowing. ETFs are transparent vehicles, so generally they would detail every day every single holding they own and the weight of that holding. And initially, people think of ETFs as being passive. Initially, when the ETFs launched, it was easiest to launch the first ETF on a very simple or common underlying. First ETF was actually created in Toronto. It was a TSX 60 ETF, but then the largest ETF in the world and most well-known one tracks the S&P 500. But sort of in the last 5 years, ETFs have then started to have active underlyings. In Europe, generally, I think a few that were not necessarily transparent snuck through initially when the rules were sort of formulating. I mean, there's no rule necessarily that you cannot have an ETF that's not transparent, but I think the regulators and exchanges now generally only allow transparent ETFs. So for an active ETF, you must disclose your holdings daily. So therefore, if there was an active manager that didn't want to disclose their holdings daily, then probably they wouldn't want to bring their ETF their strategy into an active ETF. And because they traded daily, etc., then active ETFs would generally only be on liquid underlying. So generally listed securities that have intraday pricing, and you could buy and sell on a daily basis. So generally, they'd be less relevant for property investment. And you could have a REIT, for example, but you wouldn't have a house inside an ETF. When UCITS ETFs, as the name suggests, is they follow UCITS rules and therefore can be sold to retail investors and are European-wide. So generally, the ETFs that are available to UK investors could be listed on the London Stock Exchange. Even if they're not listed on the London Stock Exchange, if they're listed on Paris or Germany or wherever, you can still buy that ETF as long as you want to trade outside of the UK. I think JP Morgan is probably the largest issuer, I think maybe by number and also assets of active ETFs in Europe. PIMCO is also one of the largest and most successful active managers. But in the US, there's been a huge wave of active ETFs, sort of relatively new and great phenomena in Europe. There is an extra benefit to ETFs in the US that isn't necessarily available in Europe, and it's mutual funds have a disadvantage in terms of the tax on trading the portfolio, and ETFs don't have that disadvantage. So hence a lot of mutual fund active managers in the US have been converting their mutual funds into active ETFs to benefit from that ETF tax that the mutual funds don't benefit from. And in Europe, you can have an ETF that has a listed and an unlisted share class. So just if you're an active manager that currently has a mutual fund that's not an ETF, you can convert that to an ETF and still offer unlisted share classes. So the listing obviously is just really ETFs are a wrapper. They allow a different form of distribution. So if you wanted to still just distribute to your normal distribution channels, you still might do that with an unlisted share class. You could have different fee structures on that. But then if you wanted to expand the distribution and try and take advantage of the growing penetration of ETFs, then you might want to offer an ETF share class that's then listed. And obviously once it's listed, you can buy it through a brokerage account on exchange, whereas generally mutual funds won't have that form of distribution.
Tom, how does the charges work on these things?
So yeah, it very much kind of depends on the ETF, right? So on the passive side of things, you're going to be looking at kind of, anything from kind of 5 bips upwards. But then obviously as you get into the more active space and more secret sources involved, then yeah, that's when issuers start kind of charging for that exposure. So on the active ETF side specifically, you've got, you do have some quant stuff, which is kind of, just going against benchmarks slightly and just trying to deliver that little bit of alpha each year. That can be as cheap as kind of 20 to 30 bips. But then if you go up towards the more kind of, 30 stock portfolio with an active sort of big active play, then you're looking at kind of 80 bips, 90 bips as well, as much as that. But yeah, you don't see much higher than that on the active ETF side for sure.
And do you get a bid offer spread?
Yeah, so you do have the spread. So that's obviously a big thing you need to look out for as an investor, is that kind of total cost of ownership. So yeah, it very much depends on the strategy and the liquidity there. But as Nick said, that's very much depends on the underlying, and most ETF issuers on the active ETF side so far have been launching strategies that are relatively straightforward in terms of their underlying, in terms of their kind of equities or fixed income. So relatively liquid compared to the sort of punchier stuff than alternatives, where you haven't really seen many active strategies on that side.
Fair enough, thank you. Which brings us on to LTAFs, which is a completely different animal.
It is a completely different beast, but actually, so following on from your comments, it is very much about alternatives in private markets. So just to sort of take a step back and explain what an LTAF is, and then I'll try and give some context about how it fits into the sort of the evolution of the UK private markets ecosystem. So what is an LTAF? It's a long-term asset fund. It is the new FCA authorized, open-ended private asset structure. It's specifically been designed to house illiquid long-term assets and broaden effectively give another structure to a broader selection of investors, mainly starting with defined contribution plans, to get access to private assets. And also this fits into the government's sort of broader theme at the moment. You're seeing in things like the Mansion House reforms around trying to find new pools of capital in the UK that can invest into areas like essential infrastructure, innovative companies and private equity and venture capital, and just generally productive finance type mechanisms that can start to drive economic growth. It's something we've seen in lots of other developed countries already, where they have more pensions capital in these sort of structures. So also just sort of giving you a bit of a background as to where these fit in alongside investment trusts and then other private market structures. So if you think about how the traditional private asset structures have been for the last 5-10 years in the UK, you've had two real options if you want to get involved with private equity, infrastructure, renewables. You can either use a listed investment trust, which is a fantastic structure for a lot of investors to get involved with private markets. You have daily dealing, that's great. So you can have liquidity, obviously at market price that is set. The other side of that is you can also have a discount. So you do experience volatility in these investment trust structures. And it's something that you obviously discussed at length today. So that's one side, and that's been a really good structure for private markets for retail investors and most of the wealth management and advice market. The other structure you had was a very institutional structure called a limited partnership. This is a structure that's been used for a very long time by endowments, sovereign wealth funds, pension funds, and it is priced at NAV. You don't get the same sort of daily volatility you get in an investment trust, but you have to be able to lock your money up for a very long period of time. So you can have 10, if not greater, years of lockup in these funds where you can't touch your money. So not such a relevant product and structure for the retail market. So where do LTAFs fit into that? It's actually somewhere in the middle. So they're not trying to sort of kick investment trusts off their sort of their ground. They're not trying to take over the institutional market. It's a semi-liquid product, so not daily liquid and not a lockup, that sits in the middle and provides you access at NAV to private markets, but for giving up some form of liquidity. So you're seeing products come to the market that have either monthly, quarterly, every 6 months, a year liquidity. And the idea of the structure is the FCA are very clear in the rules here, and this is something we can go into in a bit more detail. When you're launching an LTAF, you align the dealing terms to the underlying asset liquidity base. So the natural liquidity of the underlying assets they're creating should drive your dealing terms, not the other way around.
Okay, that makes sense. And charges like a normal kind of private equity type fund, or?
It varies. So the other thing to say about LTAFs is like we're very much in the infancy here. So there's only 3 products in market at the moment, and of those products, they've all been very clearly structured for defined contribution plans. So just give you the background to LTAFs. This actually started in 2019 when Rishi Sunak was in the Treasury. So this has come out of Rishi Sunak's Treasury. They didn't actually come into force until 2021. And then it's taken us another 2 years almost to get a product. So you can see how long this has taken. And with 3 in market and it being very defined contribution focused, where they have a charge cap, you can see that there's been downward pressure on fees for private markets. So actually, if you look at some of the charges that are coming out already, they are pretty attractive. And that's because to launch these funds, you want to have big cornerstone DC investors, and they can negotiate really good terms.
Okay, thank you. So come on to actually ETFs first. What sorts of assets sit within these things? What are people using them for at the moment?
I mean, because of daily liquidity, and they're exchange traded. I mean, exchange trading effectively requires intraday liquidity. Generally, it's for liquid assets. So something, if it's a private company or an immovable asset, a house or a farm or something, etc., then it's not going to be suitable. I mean, typically, I mean, you can see ETFs could be 100, could be 10 million one day and 100 million the next day. Alternatively, it could be $100 million one day and 10 million the next day. So you only really do that with very liquid assets. I mean, that being said, of course, listed securities can have different types of liquidity. You can manage that via weights. And, for an active manager, should obviously bear that in mind when they're putting their strategy into an ETF structure. About what their holdings are in terms of weights and allocations, etc., and liquidity. I mean, again, you can have less liquid securities, but it's generally always going to be highly liquid. And you can use derivatives and futures and things like that. But again, generally they'll be generally liquid types of securities, commodities and interest rate futures and FX futures and things like that.
Yeah.
Just sort of adding to that, if you did put a sort of a liquid security within an ETF, it'd very much behave like an investment trust, where kind of the AP wouldn't be able to go into the underlying market and create sort of shares to sort of bring that sort of trade back to NAV. So that's why it makes a lot more sense to have kind of liquid securities within the baskets.
So probably wouldn't really suit smaller companies.
Well, so I think small caps is okay if it meets the UCITS requirements and is diversified enough. We have seen occasions in the past where the inflows into a product, so say you are tracking a basket of sort of small caps and you sort of see 1 billion or sort of 5 billion go into that product, then that can start moving the underlying price and driving up the share price of those underlines. So index providers and ETF issuers have to be quite careful about that, just to make sure that the product, if there is big inflows, then it is able to sort of take those inflows on, because if it did reverse and go the other way in terms of outflows, then that would just drive the underlying performance of the companies, if that makes sense.
Can you have an active ETF with a cap on the size it in the reach?
No.
It's got to be open-ended.
You have caps on daily trading. I mean, the underlying assets could potentially cap the size. If you bought a small company, for example, and then the fund started getting large, you'd have to start buying other companies, and obviously, might buy more small companies, or they'll buy larger companies, etc. Because one thing about ETFs is they're very rare for an ETF to have a premium or discount. I mean, it could have a premium or discount of 20 bips or something during the day, or it could be 100 bips, I guess, if it's a slightly less liquid underlying. But we never trade it. We never end of the day or trade it 40% discounts or 40% premiums, because it's open-ended, and it has multiple market participants that can issue and create securities. You don't have to go to a single market participant and they give you the price of the ETF. You can go to multiple market participants, which means if the price that they're giving you is not right, the difference is going to be argued away by someone else who's willing to give a slightly tighter price.
Okay. And LTAFs, what sort of things have you got?
So the FCA really sort of helpfully outlines what you can put in an LTAF as long-term assets. So that's not very specific. What we believe that to mean, and probably what the FCA means, is private markets. And there is actually a rule within the FCA LTAF rules that says you have to have at least 50% long-term and liquid assets in the LTAF structure. So as it has been predominantly set up for liquid assets, that means anything you think of in private markets, commodities, you can have funds in there, private equity, venture capital, infrastructure. What we're actually seeing already is different types of LTAFs coming to market. So on one side of the coin, you've got very diversified global multi-asset type products. So if you're an investor who wants that type of exposure, you can get a sort of one-stop shop exposure to private markets. And then there's the other side of it, which is specific asset class LTAFs, still generally globally diversified, but for instance, renewable infrastructure globally, but across different types of technology.
Okay. And the LTAF sort of dealing rules, I mean, you say, might be something wrong with a year, but can you ever envision them ending up gating because they couldn't quite meet that? Yeah,
so I think gating in the UK market is obviously a difficult subject because of what we've seen in open-ended property, what we saw from Woodford. And I think one thing to be very clear at the outset for LTAFs is that gating is built into the structure. So for instance, if you are unable to make the redemptions, there is an ability built into the structure for the manager to gate up to however many quarters they put into the prospectus. So, I mean, really high profile example of this was last year in December when BREIT, it's a very large Blackstone real estate investment trust, it's not listed, did go to gating, and it was on the front page of the FT for a couple of weeks. But the reality was we spoke to contacts in the market and investors, and they said, well, yeah, the media's picked this up, but this is written into the prospectus that this is inbuilt. So it's just a different way of thinking about private markets. If it's in the name, long-term asset fund, you should be taking a 7, 10, 20-year view for these types of products. And it's structured to provide you flexibility around liquidity in a normal market condition. And we can go, that gets into quite the weeds, so I won't go into it, but we can talk about how the liquidity actually works if that's interesting. But in a market condition where everything's selling off, it's not expected to give you liquidity, and nor should you expect liquidity. And that's something that we are talking to investors right at the outset. And gating is one mechanism that the fund managers will have to protect investors in the fund and the asset base in the fund.
And in the active ETF space, is there some way of being able to stop dealing in fast markets, or are you?
I'd say in a perspective, I mean, it's pretty common for ETF issuers to have a gate in there of, say, 10% of NAV or AUM. It's generally uncommon to use it. I mean, even during like the coronavirus, for example, I mean, we're getting surveys from the central bank. Our funds are Irish domiciled, and we're getting surveys from the CBI every other week about you've just redeemed 15% of your fund. Was there an issue with, what happened with the liquidity of the shares? Was there any premiums and discounts? So they're hot on that. But it's pretty uncommon to gate. I mean, it could be potentially used maybe more in fixed income. For example, if someone something comes into a whack of money and there's a portfolio with high interest securities, and then currently going to buy low interest securities, and clearly if a fund was going to grow by 100%, and it was and that investor is going to get their share of those high interest securities, but then the manager has to buy low interest securities, then obviously that could affect holders. So often they might gate just to prevent fast money from going in and out, and disadvantaging investors who are longer term holders in an ETF. But again, it's not very common, but that is there just to protect people from not using the ETF properly.
And also, just adding to that, the APs who are kind of arbing this are kind of incentivized. So during your point about kind of coronavirus, we actually saw the FCA came out with a study that found kind of more APs enter the market because there was a bigger arbitrage opportunity, because ETFs were kind of trading at a discount to NAV, because the market was moving so quickly and the underlying bonds weren't trading. So it just shows you that the ETFs is a pretty efficient structure in showing that kind of price discovery to investors, and give investors an opportunity to trade in and out of ETFs. And a lot of AP stepped in because there was a good chance for them to make money on that as well.
Maybe I'll just pick up as well quickly on just to sort of give a bit of background of how do these structures work and why they shouldn't gate in normal market conditions. So when you, as a starting point for structuring a semi-liquid private asset fund, and this is, as I say, in the FCA rules, that you have to align the dealing terms, the underlying natural liquidity of the underlying. What does that actually mean in terms of an example? So if you backtest a fully ramped up global private equity portfolio the last 20 years, and you look at what's the natural liquidity of that fund over each quarter. So what's the distribution of the cash coming back into the fund every quarter? We've done that modeling on our own portfolio, and it's between 5 and 10% per quarter of the NAV that comes back into the portfolio. So how do you then set the dealing terms? We set them based on the quantitative backtesting, which is we're setting the dealing terms as you can come in monthly, you can only get out quarterly, and we're going to cap how much can come out of the fund quarterly at 5%. So you can see, based on that analysis, you set a cap that can come out of the NAV. And so in a normal market condition where liquidity is still coming back into the fund, you should be able to have at least 5% of the NAV that comes out.
Okay. Now, this morning, David Stevenson kicked off this whole conference with this sort of slightly gloomy view of the world for our sector. But what part of what he was saying was that, active ETFs would sort of eat our lunch. I think there's a sort of expectation that LTAFs might do the same from either end. How realistic is that, do you think?
Shall I start?
Yeah, I mean, I think it's just different investment products and structures, right? So everything can coexist together. And so some people might just have stopped using certain vehicles and moved to ETFs. Some people might be still stuck in other investment vehicles, and they're going to go and buy the next structure that comes in, but their next improved version comes out in 5 or 10 years. So I think some investors will still be used to buying the securities they're used to buying, or the investors are used to buying in the way they're used to buying. That's pretty. It's hard to change that what they're used to. But certainly, I mean, in terms of, you probably know this as well, like in terms of statistics, I mean, assets in ETFs have been generally growing, and assets, for example, in mutual funds, not in investment trusts, but mutual funds have been diminishing. So if mutual funds have grown, ETFs have grown by more. In years where mutual funds have shrunk, ETFs have even grown. So, I mean, that's particularly, of course, in the US, where there's a tax benefit to active ETFs. But I think ETFs probably compete more with sort of general mutual funds, but to the extent you can now offer an ETF with a listed share class and an unlisted share class, you can offer the best of both worlds. So for those that have strong distribution in mutual funds, they can still offer an ETF share class because then they can still utilize exchange and broker distribution, which is obviously related to growth in technology, etc. And obviously it's easy to scale. And there's lots of model portfolio services out there and advisors now that will only offer ETFs, etc. So it's not really, you don't have to have like one or the other. You can have both, I think. So
yeah, and I think obviously the title is a solution to why investment trust discounts. I think ETFs are obviously a solution if you have the right sort of product. Say it's a kind of very liquid investment trust. There's no reason why you wouldn't also have an ETF of the same product, and you're just distributing it to different investors. And also, I suppose with the active ETF, as I keep mentioning, kind of authorized participants can go into the primary market and arbitrage away that discount. So there is that advantage there in terms of being able to access both the primary and secondary market, whereas obviously on a mutual fund, you can only access primary market. And within investment trust, it's only on the secondary market. So there is, that slight advantage with the ETF structure.
I think on LTAFs, one first thing to say is I think LTAFs are a really fantastic extra structure to have in the UK, which increases the general choice that you have as investors, whether you're retail or professional, to get access to private markets. There is now a range of structures. You can have daily dealing, you can have semi-liquid, or you can lock your money up. And all of those are going to be relevant to different types of investors because everyone has different preferences. So if you have a very long-term time horizon ability to lock your money up in a pension, then an LTAF or a limited partnership fund might be a good structure for you. If you don't have as much savings and you need your money back tomorrow if you need it, an investment trust is a fantastic structure. I think just to give you some positivity, which we didn't have this morning apparently, I actually think fundamentally what LTAF does so FCA's focus is on LTAFs at the moment. They're really pushing for this. They're getting behind it. The government is also focused on private markets and crowding in more supply of private capital from different pools in the UK for productive finance. What does that mean for the investment trust market? I think that's really positive because it's putting all this focus on private markets in general. And I mean, anecdotally, from the conversations I've been having with the advice and wealth market in the UK, this is something that is on their agendas, and they're looking at private markets in general. They're not looking just at LTAFs. They're not looking just at investment trusts. I actually think if you get more wealth businesses that are they're putting strategic asset allocations into models for a private markets allocation, which is something I expect to happen because private markets are now 13.5 trillion in size. They were 1 trillion 2 decades ago. This is going to happen. It's going to put a lot more focus on private markets in general across structures, which is going to benefit all structures.
Okay, good. Thank you. That's encouraging. Let's now take some questions, I think, please. You start there.
Hi, this is for James, actually. What the flows been like so far? Because I mean, it's potentially quite good, but you're going to need scale for that to really improve.
Yeah. So as I said in some of my initial comments, this has been a very much a defined contribution market so far. There's only 3 in market. So we had a large cornerstone into our first LTAF in the hundreds of millions. So that gives you an idea of the sorts of cornerstones you might look to see in these structures. But it is very much tip of the iceberg stuff at the moment. What changed in June was the FCA came out with their investment policies, their policy statement on retail broadening of distribution. So now they've moved LTAFs from being a sophisticated product, which retail wouldn't have been able to access, to something that's less sophisticated and less restrictive, which means that advised and discretionary investment clients can buy LTAFs, and to an extent, up to 10% of your investable assets, if you're execution only, through something like Hargreaves, AJ Bell, Interactive Investor, you would be able to buy execution only. So they've restricted how much of your investable assets you can through an execution only, but if you're advising or you're discretionary, you can have as much as you want. So there's been no flows there yet because there are no retail structures yet. So all the structures so far in LTAFs have been set up in tax efficient pension type structures called co-ACSs. What we actually want for retail investors is OICs. So what we're looking at the moment, I know a couple of other providers are looking at are, can we bring an LTAF OIC to market, which would be the relevant structure for the retail market? So 0 on the retail side, lots of people looking at it, lots of people talking about it. It's really defined contribution, but we are positive that we think going forward there will be some interest from retail.
Thank you.
Hi there, another one for James, sorry. So I think sort of James asked earlier whether the LTAFs would eat investment trusts' lunch, as it were. Given the focus for LTAFs is, the long-term illiquid assets, I know we've had speakers earlier from Apex, we've had speakers earlier from GSEO. Why would, say, a retail investor or a wealth manager, given sort of the situation we are in with cost disclosures, want to invest in an investment trust, given the way the costs have to be presented versus a 50 bips LTAF?
I have said, I don't think there'll be 50 bips. That would be very aggressive. They'll probably, there's competitive pricing, but not that competitive, just to start with. Why would you buy an LTAF over investment trust? I don't think it's either or. Why would you buy an investment trust rather than an LTAF? Given the LTAF. The first point to mention is, I think that, there is lots of conversation going on in the background with the FCA at the moment about cost disclosure, and we are part of that engagement. And I don't want to say too much because it's sort of behind closed doors at the moment, but we are hopeful that there might be some sort of conversations that help with that, without saying too much. But in terms of why you would buy an investment trust over an LTAF, I think not all clients are going to want to have a monthly, quarterly dealing fund, which in a market environment like now may actually gate. So, that's been one of the big pushbacks I have when I go out and talk about investment trusts or LTAFs is, what if my client needs their money back tomorrow? And that's a regular conversation. It's a completely real concern for advisors and wealth managers. So I think it comes back to what structure is most relevant for your own situation. I think investment trusts do provide a very good selection of access points to private markets. I think if you're not able to take any more illiquidity than daily dealing, then the option is investment trusts. I think we as an industry do have to sort out things like costs and charges though, because at the moment, as we all know in this room, as we're in the industry, it's having a real life impact on discounts probably.
If I could add an observation to that, the obvious thing would be if I could buy a private equity fund on a 30 discount or pay asset value for it, I might as well buy it on a 30 discount.
Can I challenge that? Sorry. I think that's a completely valid point right now. But my point on strategic asset allocation still stands. I think that is a tactical asset allocation, which is very valid. But I think sometimes the ability to buy something at a discount takes our thought processes away from the fact that even within an investment trust structure, these are very long-term assets which have long-term holding periods. And the fact that you're considering it as a discount opportunity is a trading opportunity, right? And that's not wrong. It's just a different way of thinking. And if we're going to actually incorporate private markets into our portfolio, it really is about strategic asset allocation, which is on a long-term basis. And so therefore, if you can take that long-term view and have a 10% allocation to private markets, being priced at NAV would have actually given you much better diversification over the last couple of years. And then it comes down to, can you take the liquidity, etc. But it goes back to the conversation of preference. But I do think that trading is tactical.
Okay. James.
I'm going to interrupt the James and James show. Coming from a James, that's an odd thing to say, but anyway. Thinking about the solution that active ETFs are trying to solve, and I have absolutely no doubt that they will be a success because clearly there's a large part of the retail investor space that knows and loves ETFs. But one of the things that active ETFs is trying to solve is the discount problem on an investment trust. And there are structures in place that allow investment trusts to trade their own shares daily and keep a zero discount. So you know, whilst it's welcome competition, I think that there are structures in place within the investment trust world that allow them to have a similar way of behaving. In other words, a zero discount policy with all the bells and whistles and extra things that investment trusts have, the ability to use a revenue reserve to smooth dividends, an independent board, and all those sorts of things as well. So I don't think it's a shoe-in that this is a massive threat to the industry. It's something that the investment trust industry needs to be very aware of.
Yeah,
it doesn't necessarily mean that the days are numbered. I think I've been involved for 30 years and the days have been numbered at least 10 times over that period.
Exactly. Talking of which, that was a question that I had. I mean, I've always seen the presence of a board as a really reassuring thing when you're investing in an investment company. You've got people that are genuinely in charge. They can fire the manager if they want to. They can set limits on risk and all that sort of stuff. They're there fighting your corner. That's not a thing that you've got with your structures. Is that true?
In an ETF, I mean the manager has or the ETF issuer will have a board, and sometimes you have a self-managed investment company, or you might have a management company or a manco over the top of your fund company. So that would also have a board, and often it's the same board, and that board has certain regulatory requirements as well. So it has to meet all the different. I think even going through value for money these days and looking at competitive policies, what other policies exist when you're setting total expense ratios, et cetera, et cetera. So there is a board looking out for shareholders. Of course, the board might have some conflict because it's meant to have independent directors, but a lot of the board might be from the asset manager itself. But then the investor can vote with their feet. You can leave the day after. I mean, I'm not an investment trust expert, but I mean, sometimes I read articles about shareholders asking the investment trust to become open-ended or wind up so they can get the NAV for their assets. So and often they don't do that. So I guess there's some conflicts of interest there as well, that they're not winding up the assets because their jobs might be gone, etc. So I'm not an expert in investment trust. So
you can call a vote and put it to the vote. So yeah.
Yeah, similarly for an LTAF, I mean, so there is a board in place, but it is a predominantly internally managed board at the fund manager. There are NEDs on that board, but it's not a fully external board like you would have on an investment trust.
Okay, cool. Any more questions from the room? Yes.
This is regarding active ETFs. For DFMs such as myself, I think one of the major benefits of investment companies is the third-party research available. In a more developed market such as the US, is the research from analysts covering active ETFs?
I think you take on that one.
Yeah, I mean, if you compare it to the companies, I mean, you generally would have an analyst covering an ETF where they're writing research on the companies, for example. But I mean, the issuers do provide research about the holdings and the strategies, etc. In an ETF, you've decided that you want to invest in a particular theme. So you might have done some research or from the internet, etc., and said, well, I want to invest in robo and AI, or I want to invest in Bitcoin. Therefore, then you might look at what robo and AI or Bitcoin ETFs or etc. And then make a decision. So be more like generic, objective, factual research as opposed to like buy this now or sell this now. I mean, an advisor might be doing that with their clients, saying this is a good ETF to buy today. But there would be generally analysts putting reports out there saying buy, sell, like it might for companies or investment trusts.
When in ETF stream, are you looking at how well active ETFs are doing relative to benchmarks and things? Are you reporting on that sort of stuff?
We don't actually report on that specifically. Maybe that is something we should look at more. But no, we're very much kind of tracking the market as a whole and just sort of tracking that active ETF uptake. Obviously, looking at specific strategies that get flow. But yeah, this is, I suppose, that is something we can look at as well. But we are seeing quite a huge number of issuers entering the space. The likes of kind of AXA, Aberdeen, Robeco, obviously Fidelity, JP already there. So it is a huge wave coming. But one point I did kind of want to make that I don't think I wasn't wasn't going to be able to, was around the distribution of ETFs, which is quite an interesting one at the moment with the UK, because I think one thing really stopping this kind of uptake of ETFs is the kind of platform issue. And a lot of ETFs struggle to kind of list across a lot of platforms because of fractional dealing and all those issues. So I think that's one point that I think would be really helpful for the ETF industry in particular if we did solve that platform issue. So that would put us on a kind of
platforms are a
level
common
playing
enemy, I think.
Yes.
Fair enough.
Hi, can I ask you about ESG in ETFs? We know that the ESG data providers, MSCI, Sustainalytics, and so on, only cover a fraction of each market. And what they do cover is quite often quite subjective, with very different ratings for the same company from different data providers. As the world wants to know more about ESG, and as regulations require more data on ESG, why should an investor choose an ETF where you're investing in every single stock in a particular index, or an active ETF where it's just a more limited number of them, where the ESG data can surely only be cursory?
Well, I think, yeah, you're right. I think you do need to be very careful about those ESG ratings providers. And I think you need to have a look at exactly what they're up to. And it sounds like you are, but I suppose on the active ETF side, that's that's the issuer, the asset manager taking a view as well. I mean, ESG is very subjective. So I suppose it's more of a case of making sure you're aligned with the correct asset manager or the correct issuer or the correct index provider, depending on your point of view, because ESG is, as I said, is such a subjective view. But it sounds like active ETFs would be potentially more suitable. They have a bit more impact in them, and that's the same with thematic ETFs as well. They're a bit more narrow in their benchmark. So that might be it also for Nick. I don't know.
Yeah, I mean, active ETFs is a good example where it's an opportunity to grow because the manager is actually is buying and selling stocks on a daily basis based on what it believes. So if it has certain ESG criteria, it can purchase or sell a security because it's done X, Y, Z. Whereas for an ETF, obviously, for a passive product, it might be taking some data and then taking some objective rules and saying, well, based on the data, I'm taking the top 20 or the top 30, etc. And obviously, ESG data is going to improve over time. So we're only sort of at the infancy stage. Of course, at the infancy stage, things will be very variable, etc., and only get better over time and cover more of the universe and get better at predicting various scores. But I guess from the investor's perspective, it's like, how active or passive are you? You might say, I want to invest in technology, but I'm not that much of I don't know that understand much about technology. Therefore, I'm going to buy the NASDAQ or a triple Q ETF, or I'm going to buy a cloud computing ETF because I think cloud's going to grow, but I don't understand the stocks. So I guess in terms of ESG, you can say, well, I want to buy an S&P 500 ETF, ESG weighted or whatever, because I want to feel like I'm doing a bit, but I don't understand enough to have done all the research to know that I prefer this manager or that manager or this ETF over that ETF, etc. So I guess it's sort of horses for courses at the moment, and the optionality exists. But yeah, I mean, there's definitely room to improve over time, but I think we're just sort of at the nascent stage of the industry, so it'll only get better.
Cool. Online questions?
One question: how do active ETFs deal with corporate actions? That's the first question.
I think a passive ETF would have rules about how it deals with corporate actions, and an active manager would deal with however it wants. So it might take up the rights issue, or it might sell the stock, or etc., or buy more of the stock. If there's an acquisition, there's obviously some active managers can be trading M&A, etc. So it's completely up to the active manager. But that actually reminds me on ESG and voting. I mean, some data providers now, are trying to allow individual shareholders to vote. That's obviously easier when you have, for example, a mutual fund, for example, where you know exactly who's on your register, like because you've got a list of someone's had to come and buy from you, and you've got their details. Whereas you buy an exchange, and you're holding through nominees and custodians, you don't actually know who's holding the stocks, but there are data providers out there that are trying to crack that. So at some stage on ETFs, you may actually be able to vote on the underlying at AGMs or for boards, etc., or around ESG type voting, or alternatively, an ETF could say, albeit it's a systematic, I'm going to vote according to these principles. So you might not agree with every principle, but you're going to know that they're going to vote with certain principles. So at least you've got some comfort that they might get 70% of it right in terms of your own personal view.
I've just spotted we're actually at time. So one more question?
Sorry, it's probably a difficult one. So ETFs have exploded in terms of the number of people that issue them. Do you foresee that we can get to a point? I mean, how expensive are these things to create now? Do you foresee a point where people can sort of almost individual wealth managers, the IFA off the street, could almost structure their own ETF and get their own investment ideas in there as a way of creating potentially a retail friendly product for their particular clients? Do you see a future for that?
Just quickly from my perspective, I suppose running an ETF business is actually relatively expensive. So I think you will face challenges from that side of things. But Nick, I'm sure you've got some.
I mean, ETFs are generally quite cheap to buy. But actually, like Moise says, to run generally, because you're taking a mutual fund and then adding on exchange trading. So you're actually adding a layer of an extra benefit. So that doesn't come for free. But I mean, our firm allows people to come who don't want to launch, like managers don't want to launch an ETF, or a broker could have some tied distribution or some tied assets and doesn't know how, or doesn't want to create an ETF business, but they want to create an ETF. So you come to me, I could bring them to market faster and much cheaper than they would do. They wouldn't do it on their own, probably. I mean, I guess there's a new development in terms of investment management, where there's direct investing, and brokers and money managers are allowing individual investors to effectively create their own portfolio like an ETF. But an ETF is for the masses, where this is almost like creating an ETF for a single person. So that is a new area as well.
So
Yeah, I think the tax advantages there's a tax drag on mutual funds when they're buying and selling the underlying. With ETFs, you can deliver cash for the asset manager or an intermediary to buy the underlying portfolio, where you can actually buy the underlying portfolio itself. So when you deliver the portfolio and take back the portfolio, there's no gain or loss on those securities, because the securities are just brought in and out. You receive the security, you gave the security back. And so in the US, that benefit exists with ETFs and doesn't exist with mutual funds. And so there's a tax advantage for US investors to buy an ETF over a mutual fund. That's why why ETFs have grown much faster in the US than Europe, because that extra tax advantage doesn't exist in Europe. I mean, tax-wise, I mean, every level of investor, institutional, pension funds, or retail, or et cetera, we have that in the UK, and there's 28, 29 countries in Europe today, so they all have their own rules. So it depends on who you are as a specific person about whether an ETF is more tax advantageous or potentially less tax advantageous than the other vehicle that you're considering.
I think we really do have to leave it there. So thank you very much indeed.